Let's cut to it. Growth without profit is nice. EBITDA, CAGR, and the rule of 40. They bring these signals together. These metrics show investors you're not just guessing, you're running a tight ship. They guide hiring, spending, and scaling. And they give you a good scoreboard. You want to benchmark against the best? This is where you start. And this is how real operators run their ship. EBITDA tells you how your core business performs before taxes, interest, and other accounting trips that muddy the water. It's your pure operating profit. And the margin? That shows how efficient you are. No distractions, no spend, just real profitability you can actually count on. CAGR smooths out the hype. It shows how fast you actually grow year over year. Pair it with the EBITDA margin using the rule of 40. Why? Because a 30% growth with a negative 20% profit isn't winning. But a 20% growth with a 25% margin, that's pure magic. So the rule of 40 is your North Star, especially when the investors are watching you like a hawk. Let's look at the Peloton story. In 2024, Peloton's financial metrics highlighted significant challenges. Their EBITDA showed a loss of $338.6 million, indicating operational inefficiencies. Their EBITDA margin, a negative 12.54%, meaning the company lost over 12 cents for every dollar that they earned. And the 3-year CAGR is a negative 12.44%, reflecting a consistent annual revenue decline. And the rule of 40, a combined score of negative 16.11%, falling well below the healthy benchmark of 40. These figures underscore the importance of balancing your growth with profitability. For SaaS companies, maintaining a positive rule of 40 score is crucial for sustainable success. I have lived this. At a fast growing startup, we focused too hard on just EBITDA. To hit our short term numbers, we froze hiring, we cut our headcount. It was just a bad move. Innovation slowed, the morale dropped, and the customer churn just skyrocketed. That's why these benchmarks matter. EBITDA shows efficiency, CAGR shows growth, and the rule of 40 shows if both are working well together. You need all three, just don't pigeonhole on one of them. Now, do you want to level up fast? Here's how you do it: tighten your pricing, use stable COGS to lift your EBITDA, track CAGR with retention to know if your growth is actual, cut your infrastructure bloat and not the impact. Use the rule of 40 to drive spend and build a dashboard that makes your performance impossible to ignore. Don't do any guesswork, just execution.